Let me take you through something compelling. While you were watching silver trade at 33 on your screen yesterday, someone in Shanghai just paid $72 for the exact same ounce. Not a typo, not a mistake, not some weird conversion error that financial media will dismiss by morning. The Shanghai Gold Exchange reported physical silver transactions at prices that would make your local coin dealer spit out their coffee. Before you think this is just another premium spike story, before you file this away as crazy Asians panic buying again, stop. This isn't about premiums anymore. We're watching the paper market lose its grip on price discovery in real time. I've been tracking precious metals for 2 decades. I've seen premiums spike during supply crunches. I've watched delivery delays stretch from days to months. I have observed the usual dance between physical and paper prices, that traditional relationship where paper leads and physical follows with a slight markup for the inconvenience of actually holding something real. This is different. Here's what this really means. When physical silver trades at more than double the COMEX price, you're not looking at a premium. You're looking at a completely separate market that stopped pretending the paper price is legitimate. Think about that for a second. The world's most populous nation, the world's largest manufacturing economy, just told the COMEX and the LBMA that their price discovery mechanism is irrelevant. The Shanghai premium didn't climb to $72, it jumped there. One day you've got the normal friction between paper and physical, maybe $2, maybe $5 over spot during tight periods. The next day you've got people paying double. That's not a market adjusting, that's a market breaking. Let's dig into the mechanics here, because this matters. The Shanghai Gold Exchange isn't some backwater operation, it's a delivery market. When you buy silver on the SGE, you're not getting a certificate. You're not getting a promise. You're getting metal. Real, weigh it yourself, put it in your vault, silver. Compare that to COMEX. On the COMEX, for every ounce of physical silver in the registered vaults, there are somewhere between 50 to 100 paper claims. Some analysts put that number higher. The exchange will tell you that's fine because most contracts settle in cash. Most traders don't want delivery. It's a pricing mechanism, they say. A financial instrument. Sure, until everyone wants delivery at once. Shanghai just raised their hand and said, "We want delivery." And the price instantly reflected what silver actually costs when you have to produce the physical metal instead of printing a contract. Now let's connect the dots. China isn't just buying silver for investment portfolios. They're buying it for solar panels, for electronics, for industrial applications that can't wait 3 months for delivery while some COMEX clearinghouse shuffles warehouse receipts. When a Chinese solar manufacturer needs silver, they need it now. They need it in their factory. They need the actual metal. And they're willing to pay what it actually costs to get it. The Western financial media will ignore this story by Friday. They'll memory hole it the same way they buried the nickel market explosion on the LME. Remember that? March 2022. Nickel prices went vertical. The London Metal Exchange literally canceled trades and shut down the market to protect a Chinese billionaire from a bad short position. They just erased transactions. Billions of dollars in trades, poof, never happened. You think they won't do the same thing with silver? Let's pause and consider what happens when the 2-tier pricing becomes permanent. We've already seen it with gold. The official gold price suppression scheme that leaked through those Deutsche Bank and UBS settlements, they admitted it. They pleaded guilty to spoofing gold and silver prices, paid their fines, kept their licenses, business as usual. But even with that manipulation, gold found its floor. Gold kept climbing because central banks kept buying. Now silver's doing something more dramatic. Silver's bifurcating. You'll have the Western paper price, useful for settling derivatives, for the bank algorithms, for the financial engineers who profit from volatility rather than actual value. That price will stay suppressed as long as the COMEX has enough physical metal to satisfy the 1 to 2% of contracts that actually demand delivery. Then you'll have the real price, the Shanghai price, the price that reflects actual supply and demand in the physical market, the price that industries pay when they need silver today, not someday. This is the takeaway. That spread between paper and physical is the value of the lie you've been sold. Every silver investor in the West has been told that COMEX sets the price, that London sets the price, that paper markets are efficient and reflect true value through the genius of financial engineering. The Shanghai premium is proof that's propaganda. And when silver hit $72 in Shanghai, that wasn't irrational exuberance. That was reality breaking through. That was the market saying, your paper games don't work here. I want you to understand the position this puts Western investors in. You're holding silver, maybe physical, maybe SLV shares, maybe futures contracts. You've been watching that COMEX price tick up slowly, 24 posts, 26, 30, $33, feeling pretty good about your position. Meanwhile, in the real world where people need actual silver for actual production, the price just doubled. Your silver didn't double in value on your brokerage statement. Why not? Because your silver is priced by a market that's increasingly divorced from physical reality. Your wealth is being stolen by the gap between what silver trades for on paper and what silver trades for in reality. Here's the math that should terrify the COMEX. If Shanghai is willing to pay $72 and arbitrage still exists, why wouldn't every silver holder in the West demand delivery and ship it to China? Even accounting for shipping, insurance, and processing costs, you're looking at potentially 100% profit. The only reason that arbitrage isn't happening is friction. The COMEX makes delivery intentionally difficult. You need to take delivery in specific bar sizes. You need approved storage. You need to navigate a bureaucratic maze designed to discourage physical settlement. But that friction has limits. Push the premium high enough and the arbitrage becomes too profitable to ignore. Someone will do the paperwork. Someone will jump through the hoops. Someone will drain the COMEX vaults and ship that silver east. Then what? The COMEX has two choices when the vaults start emptying. Let the paper price rise to reflect physical reality, or declare force majeure and settle contracts in cash at whatever price they decide is fair. Guess which one protects the banks? Let me show you why this matters beyond just silver investing. This is about the entire commodity pricing structure that underpins global trade. The West has controlled commodity prices through paper markets for decades. The COMEX, the LME, the LBMA, these institutions have been the gatekeepers of price discovery. That era is ending. China's been building an alternative infrastructure for years. The Shanghai Gold Exchange, the Petro-Yuan, bilateral trade agreements that bypass the dollar. They're not doing this because they hate America. They're doing it because they're tired of buying real goods with real labor and receiving paper promises in return. Silver at $72 in Shanghai is a symptom of a larger divorce. It's China saying, we'll set our own prices for physical commodities, thank you very much. Now, let's connect the dots. This isn't happening in isolation. Look at what else is moving. Copper premiums in Asia are elevated. Aluminum's showing stress. Even zinc is getting weird. Industrial metals across the board are showing the same pattern. Paper prices suppressed or stable in the West while physical premiums explode in Asia. This is the infrastructure of Western financial control crumbling in slow motion. The banks know this. The Fed knows this. They're just hoping you don't notice until they've repositioned. Think about the timing. This Shanghai silver spike happens right as the U.S. Treasury market is showing serious stress, right as regional banks are still sitting on unrealized losses, right as commercial real estate is imploding, right as the Fed is trapped between inflation and recession. You think that's coincidence? Physical commodities are the escape hatch when paper markets fail. When confidence in financial instruments erodes, people flee to real things. Commodities, property, productive assets. The Shanghai premium is Chinese investors and manufacturers saying, we don't trust your paper anymore. Here's what this really means for your portfolio. If you own paper silver through ETFs like SLV, you're exposed to the Western pricing mechanism. You're at the mercy of the COMEX. You're hoping that when push comes to shove, those ETF shares can actually be redeemed for physical metal. Good luck with that. SLV's prospectus is very clear. In times of stress, they can settle in cash, they can suspend redemptions, they can do whatever protects the authorized participants, which are, surprise, the same banks that run the COMEX and profit from price suppression. You're not holding silver. You're holding a claim on silver priced by people who profit from keeping silver cheap. Physical holders are in a different position. You've got the metal. You can wait. You can hold through the paper market manipulation because eventually physics wins. Eventually, the industrial demand that can't be met by recycling and mining has to bid up the price. But here's the twist. If Shanghai's paying $72 and you're in the West, you can't actually access that price. You can't just ship your eagles and maples to China and collect the premium. There are capital controls, export restrictions, logistical nightmares. So you're stuck in a weird limbo, holding an asset that is worth $70 in one market and $33 in yours. That spread is information. That spread is telling you something important. Let's pause and consider. What breaks first? Does the COMEX price eventually rise to meet Shanghai? Does Shanghai's premium collapse back to normal? Or do we just permanently exist in a world with two silver prices? History suggests the answer. Go back to the 1960s, when London had one gold price and the US had another. The London gold pool tried to suppress gold prices by dumping physical metal into the market. They tried to maintain that $35 per ounce official US price while London traded higher. It failed, spectacularly. The pool ran out of gold. Nixon closed the gold window, the dollar devalued, and gold eventually found its true price in the thousands. Silver's following the same path, just faster. The COMEX doesn't have unlimited physical metal to dump. Mining production is relatively inelastic. You can't just snap your fingers and produce millions of new ounces. And industrial demand is growing, not shrinking. The math doesn't work. The paper market is writing checks the physical market can't cash. Here's the important part. You're watching a repricing event in real time. Not the repricing, not the final move, but the first crack in the dam. When Shanghai hit $72, that was the market testing the system. Seeing how far the premium could stretch before arbitrage mechanisms kicked in. Seeing whether Western holders would flood the market with physical to capture that premium. The answer appears to be no. The premium spiked and held, which tells you the friction is real. The barrier between paper and physical markets is stronger than traditional arbitrage can overcome. That's a broken market, a permanently broken market. Now watch what happens next. Chinese manufacturers who saw silver at $72 are going to start sourcing differently. They're going to lock in long-term supply contracts. They're going to build strategic reserves. They're going to do whatever it takes to ensure they are not held hostage by extreme premiums again. That's demand that never comes back to the spot market. That's ounces pulled out of circulation permanently. Meanwhile, Western investors are still buying paper, still trusting that SLV owns the silver it claims to own, still believing that their futures contracts will settle in metal if they want it. The divergence gets worse from here. One thing that really stands out to me, I need you to understand something about market structure. When physical premiums stay elevated, it creates a feedback loop. Refiners start allocating metal to the highest bidder. Mining companies negotiate better terms with Asian buyers. Wholesale dealers start shipping east instead of filling Western retail demand. The COMEX ends up as the buyer of last resort, maintaining an artificial price that fewer and fewer physical market participants care about. This happened with palladium a few years back. The paper market said one thing, the physical market said another. Eventually, the COMEX just became irrelevant for price discovery. Physical palladium traded at whatever buyers were willing to pay, and the futures market existed mainly for financial speculation disconnected from the real metal. Silver's bigger. Silver matters more. Silver has more industrial applications and more investment demand. But the pattern's the same. Think about that for a second. The world's most important price discovery mechanism for silver might just become a sideshow while the real price gets determined in Shanghai and Mumbai. Your investment strategy needs to account for this. If you're buying silver as inflation protection, as crisis insurance, as a bet on monetary chaos, you need physical. You need metal you control. Because when the paper market finally admits defeat, when the COMEX declares force majeure or the ETFs suspend redemptions, the price of physical is going to gap up violently, and you won't be able to get it. Every dealer will be sold out. Every mint will have 6-month backlogs. Every private seller will be asking prices that make today's premiums look quaint. The Shanghai premium isn't a warning. It's a preview. Now, let's connect the dots on the banking side. The same institutions that manage the COMEX are sitting on absolutely massive derivative books. JP Morgan alone has hundreds of billions in notional precious metals derivatives. These positions are hedged, they'll tell you. Risk neutral. Hedged with what? More paper? More promises? More contracts that assume the underlying physical metal will be available at some theoretical price? When Shanghai paid $72 and New York paid $33, someone's hedge broke. Someone's risk model just showed a red flag. Someone's quant is explaining to senior management why their impossible scenario just happened. The banks will manage this carefully. They'll use every tool available to suppress panic. They'll deploy the plunge protection team for precious metals. And yes, that exists, just not officially. They'll call in favors. They'll coordinate with the Fed and the Treasury and the LBMA. But they can't create physical silver out of thin air. They can't mine it with an algorithm. They can't QE their way to more ounces. This is why silver is different from financial assets. You can print bonds. You can create synthetic equity exposure. You can inflate your way out of debt. You can't inflate your way out of physical silver shortage. The Shanghai premium is telling you we're entering that shortage. Not next year, not eventually. Now, here's what happens in the next phase. Western investors start noticing. Reddit lights up. Twitter threads go viral. Some YouTuber makes a convincing video about the Shanghai premium. Retail demand surges. The mints can't keep up. Dealers go to allocation. Premiums in the West start climbing. Not to $72, but enough to hurt. Enough to make SLV look questionable. Enough to make people want delivery from their futures contracts. COMEX inventories start declining, not crashing. They're smarter than that. But bleeding, slowly, steadily. Then a fund somewhere decides to take a big position. Decides to actually demand delivery on size. Decides to test whether the emperor has clothes. That's when it gets interesting. The COMEX will fight back. They'll raise margin requirements. They'll change delivery rules. They'll do whatever it takes to discourage physical settlement. But every defensive move confirms the thesis. Every rule change proves the skeptics right. The paper market's legitimacy dies from 1,000 cuts. I've watched this movie before with different assets. I saw it with rhodium, saw it with palladium, saw it with cobalt. Every time, the paper market insisted it had control right up until the moment it didn't. Silver's bigger and more important, so the fight will be more intense. But the ending's the same. Here's the important part. You have time to position yourself. The Shanghai spike was a flash, not the new normal. Premiums will probably come back down temporarily. The system will reassert control temporarily. Things will look normal again temporarily. Use that time. If you're holding paper silver, understand your counterparty risk. Understand that your brokerage statement doesn't mean you own metal. It means you own a claim that might or might not be honored when you need it most. If you're buying physical, understand that today's premiums, whatever they are in your local market, are probably the cheapest you'll see for a long time. The trend is established. The divergence is growing. If you're waiting for confirmation, waiting for the mainstream media to validate this story, waiting for your financial advisor to recommend precious metals, you'll be too late. By the time CNBC runs a special on the Shanghai silver premium, the metal will be gone. This is how real market dislocations work. They start in obscure corners. They get dismissed by experts. They build slowly, then suddenly. Shanghai just provided the slowly part. The suddenly comes later. And when it does, the people who understood what $72 silver in Shanghai really meant will be positioned correctly. Everyone else will be scrambling, confused about why their paper profits aren't spendable and their ETF shares won't redeem. This is the takeaway. Market structure matters more than price. The Shanghai premium isn't about whether silver goes to $40 or $50 on the COMEX next month. It's about whether the COMEX price remains relevant at all. We're watching the slow-motion demolition of Western commodity price control. The paper markets that have dominated for 50 years are losing their grip. The physical markets are asserting independence. Silver at $72 in Shanghai is a declaration of independence. Your portfolio needs to reflect that reality.